Hello everyone. We are into our part two of itemized deductions here in our discussion of that. So we're moving down the Schedule A. We've already done our medical expenses and talked about taxes. And now we're going to talk about interest. This is often the biggest for those who own their own home and have a mortgage. This is usually the biggest chunk of their itemized deductions. Usually determines whether or not they itemize is whether or not they have this deductible interest. But there are some limits. The basic idea is if you borrow money to buy a home, if it's qualified residence, and we'll talk about other residences in another chapter, but this is on your main home, the one that you live with. You can get a second home deduction if you have, share houses, but the total amount of indebtedness can only be $750,000 beginning in 2018. Before that, it was $1 million. Okay, it's only the interest on that amount. So if you borrowed $1.5 million to buy your home, whether it's two or one, any interest on the amount over that would be disallowed. Okay, so the home equity loans changed in the new tax law in 2017 with the idea that home equity loans, or second mortgages as they're sometimes referred to as, are only deductible going forward on those amounts that are used if you borrow the money and used it to improve or acquire a home, or build onto it or add onto it or something like that. If you borrow the money and take a vacation with that money, that is no longer deductible. That was not the case in the past. It didn't matter what you used the money for. All that matters is it was secured by your home. So with the lower limit on the acquisition indebtedness, there's also the idea that is per person. Okay, so not a per residence basis. This is a situation where things go to the courts, and then the court interprets what the tax law how it should be interpreted, and it has been per person, not per property. So that's how to measure if you're over the limit. Now, another part of interest is points. This is what you pay often at closing in order to get a lower interest rate. So it typically is based as a percentage of the loan principal, and that sort of thing. Now, the general idea is when you have points, you pay. This is really prepaid interest. So you pay more up front in order to save money later. And the points are, the typical rule is points are spread over the lifetime of the loan. So if you pay it now, you don't get a special benefit. However, if it's your primary residence and it is basically the way it's handled most of the places, and that's the case in most places in the United States, points are kind of a typical way of doing business for mortgages, then you can deduct it all at once. That's a big difference for someone on their primary residence to be able to take points all at once when they buy their home. Okay, and that can be a big deal when they first buy that house. However, if you refinance, paying points is not going to be all at once. So on that situation, it's that original loan. The other kind of thing that's not really interest but is reported with interest and shows up on the Schedule A, and in the interest section is private mortgage insurance. This is, I want you to understand, not homeowners insurance. Homeowners insurance is not deductible as an itemized deduction. That's the stuff that pays out if you get your house gets burned down in a fire or something. That's homeowners insurance. Private mortgage insurance is insurance you buy that will pay your mortgage if you are have to have financial trouble and can't make your mortgage. So it's going to make your bank make payments to the bank or cover you in that situation. Typically, a lender is going to make you buy this insurance if you borrow more than 80% of your house. Once you have 20% or more equity in your house, they don't worry about it. But you generally have to before that. And you're going to see it on the 1098, line 5, as it says there. And it's deductible in the same way as interest, so it could add to your total itemized deductions. However, it is phased out. It phases out at $100,000, and this has a little different phase out. It would be much easier if every one of these different deductions had the same kind of phase out, but this is phased out by 10% for every $1,000 you're over $100,000. So if your AGI is $102,000, that means you would lose 20% of your deduction for the PMI. And if it was $108,000, you would lose 80%. So it's completely gone when you hit 110, because that would be 10%. That'd be 100% that you would be losing. So that's how that phase out works. All right. The last area of deductible interest that we want to talk about is not on your house. Okay. So personal interest on your credit cards, anything, your car loan, those are not deductible. So you have interest on your home, second mortgage in certain circumstances. You've got the PMI, you've got investment interest. This is money you borrowed and pay interest on to buy things to have an investment. So maybe you borrow money to buy stock, or you buy money to buy property up in the mountains that you hope is going to someday increase in value and you'll sell it. Okay, that would be investment interest expense. However, the problem with this is it is limited to your net investment income. So whatever you invest into has to make some money, or you have to have other investment interest. Doesn't say it has to be that particular investment, but you can only deduct this to the amount that you have net investment interest. And any of the others, any additional investment interest expense is carried forward. Now, it can be carried forward for as long as you need to, but it is carried forward. It's not a deduction now. So if you borrow money, pay $1,000 of interest on that money to borrow it, and you invest it, and you earn only $800 in interest on that money, you're only going to be able to, you're going to have to report your $800 of interest income the same way as we learned back in chapter 3, but then you'll deduct only the $800 here on Schedule A as investor interest, because that would be your the limit. Now, the other thing is notice it says net investment interest or net investment income. You have to take other expenses against that investment income first before you take the interest. So if you paid broker fees or some other types of expenses, those would have to be deducted first before you and would reduce your limit of how much investment and interest expense you can deduct. So you need to be aware of that. See, that's an issue if you borrowed $50,000 and bought land that's just going to sit there that you hope someday you're going to find oil or gas or gold or something on, but right now it isn't earning anything. you're paying interest on that. You're not going to have any net investment income on that property, from that property, unless you have it from some other property, some other place. You're not going to be able to deduct that investment interest you're paying on that $50,000 you borrowed to buy that land. Okay, so that's your challenge. All right, gifts to charity. All right, this is your charitable deduction. There's some differences that came in the new tax law referenced here. The overall used to be at AGI. Here it comes back, AGI issues again. In this case, you are wanting higher AGI because the amount of your charitable contributions is limited by a percentage of your AGIs. You can't contribute more. You can contribute more, but you can't deduct the contributions any more than that. And so it went from 50 to 60% now is the overall. So no matter how much you give, the most you could deduct is 60% of your AGI as a charitable contribution. That's no matter how you give or that sort of thing. So that's the first limit. And then the other limits come into play depending on the type of property that you are giving and to who you give it to. Okay. First of all, no deduction to just gifts to individuals. They always have to be to a recognized charity or organization. And there has to be a way to put a value on it. It doesn't have to be cash. It can be other property, but there has to be able to be a value. Your services, your donation of services, you showing up and volunteering is not deductible and not counted as a charitable contribution. There is a very small deduction for driving for charitable purposes for the use of your vehicle, but it's not for your time. It's for the use of your vehicle in the charitable purposes. So what are the other limits? You got the 60% overall. That also applies to cash given to public charities. Okay, 30% is is an AGA limitation to contributions of appreciated capital gain property to public charities, and the 20% is for donations to capital gain property to a private foundation. Now, a private foundation is different than a public charity. Most of the charitable contributions you would think of organizations are public charities. The Salvation Army, the Red Cross. These are ones that get most of their money from donations from the public. A private foundation is going to get almost all of its money from a particular family or individual, a very small number of donors, like the Ford Foundation or the Packard Foundation, where it's funded by someone and they die, or when they give a whole lot of money, and that's where all the money comes from. If you give to that, the limits are lower. So if you give a capital gain property to a public charity, usually you can deduct a fair market value. All right. However, if it is put to an unrelated use, it must be reduced by the capital gain. So if you donate to the school something they're going to use for the school, then that can be done at fair market value. If it's done at, and then remember, this is capital gain property. This is this is not inventory that you would use. This is artwork or gold or something like that. That's the type of capital gain property if it's held long term. If it's held short term, then the deduction is limited to the tax basis of the asset, whatever you paid for it. You don't get this extra thing. So donating stock to an charitable organization is a great tax planning issue. You bought Microsoft stock, it went up in value. Instead of selling it and giving the cash to charity, you give the actual stock to the charity. That allows you to take a deduction for the value of that stock, then, and you don't have to have any gain that you report as income. You give that gain away to the charity. You get the maximum deduction because it's a fair value. Okay. What do you have to show if you give money to charity? It's become more stringent. It's under $250. It can be the canceled check, but if it's over, the written acknowledgement from the recipient organizations put a lot of emphasis on the actual organization sending you something that says thank you for your donation. You didn't get anything in return for it. It was just out of the goodness of your heart. If you donate more than you can deduct because of these limitations, you get to carry it forward, but only for 5 years. Only for 5 years. Casualty and thefts really have become a much more rare thing under the new law. It has to be only in a federally declared disaster area. It used to be much broader. So you can only have casualty, which means you're basically theft losses don't happen anymore because that's not what happens in a federally declared disaster area. So it's really only flooding and earthquakes, that sort of thing, and it's sudden, unusual, and you're talking about what you actually lost that is not reimbursed by insurance. We talked a little bit about reimbursed by insurance under medical expenses. It comes up here. So your house gets washed away in a flood, you get paid. It's you're only looking at the loss that's not covered by insurance. So if in some cases you won't have any loss because your insurance, if you have good insurance, is going to pay more than what the property was worth. So the loss is the drop in the fair market value because of the casualty, or the amount you actually pay, the adjusted basis for the property when it was washed away or whatever. So whatever is less. Notice it's the lesser. It can never be more than what you paid for it. Okay. Report that, and besides the fact that it has all these other limitations, you have to take each casualty reduced by $100, and then the loss has to be in excess of 10%. It sounds familiar. Just like medical expenses, got to be over a certain amount of AGI. You report them on Form 4684. Really, other itemized deductions went away, or most of them miscellaneous itemized deductions. No longer a 2% AGI limitation because they don't exist, period. They were taken out of the tax law. Remember, if it's not in the tax law, you don't get to deduct it. Okay, so we're really left with only the casualty and theft losses from income producing property, and the one that everybody likes to talk about, gambling losses. Notice it is only deductible to the extent of gambling winnings. You put your winnings on Schedule 1 in line 21. It's other income. Losses can go here, but again, this is only going to work if you itemize. So if you don't have enough total itemized deductions to get over more than the standard deduction, your gambling losses don't do you any good. So when someone asks you about the deductibility of gambling losses, you need to remember that this is the issue, and many of the folks are not going to be able to deduct their gambling losses. And then if they really feel like they've got enough that they can, and they have some winnings that they've reported, then they've got to be able to actually show their losses, which most people don't keep their records of what their losses are. So you hope that they are gambling somewhere that gives them some kind of printout that actually shows them how much they lost. I've seen those. So that should conclude our itemized deduction discussion.